Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. Energy companies have been on fire for the past 2 years right now. And if you're in these stocks, then you've been loving it. Last month, I released a video about 3 top energy companies to invest in. Some companies, which included Obsidian Energy Group, Gran Tierra Energy. And those companies I really believe are in a really good position right now. And I believe they're going to continue to do well in the near future. But there have been a couple smaller cap stocks that have really caught my eye within the last couple weeks. So I want to share those with you guys today. Now, keep in mind, because they are smaller cap companies, and obviously within the energy field, there's going to be a lot more volatility within these stocks. So just keep an eye on it. Make sure you do your due diligence before you're actually investing. If you want to stay up to date with all the energy stocks or any stocks in general and get the financial analysis, don't forget to hit the subscribe button and go long on the like button. Appreciate it, guys. Our first company for tonight is TransGlobe Energy. TransGlobe Energy is a cash flow focused international oil and gas company whose current activities are concentrated in the Arab Republic of Egypt and Alberta, Canada. All right, so I'm pretty excited about this company right off the bat, guys. They've got a lot of good prospects, a lot of good opportunities within their production lined up ahead. So this is more of a little bit of a longer term play, in my opinion. Probably a company that I would invest in for looking within a year, 2 years period of time. This is a company where I'd be confident as long as oil prices are staying relatively high in the 80s, then this could be a pretty profitable company. If we take a look at their 1-year performance, 198% over a 1-year period, which is killer. We look at year to date, 48%, almost 49%. Which is really solid for year-to-date performance, especially compared to those big, tech companies, growth-oriented companies. If you have energy layered into, or if you had energy layered into your portfolio, then you're going to be pretty happy about it because it hasn't been as volatile. It hasn't been it hasn't been negative the entire time. Now, keep in mind, this is a smaller cap company, as I mentioned before. So their market cap is about $350 million. So really, it's a small company here, guys. Smaller production. The price per share is about $4.50. Earnings per share is $1.23. So that's strong, especially considering their price. The price to earnings forward multiple, we're looking at 3.73. So that's a really good multiple. Lower multiple for the company, we like to see that. That's more important. Higher multiple, not something we usually love to see. One of the reasons I'm really excited about this company is that they have more of a revitalized, as they're saying, a revitalized portfolio. So they have certain projects that are pretty much coming to their endpoint, where they're going to be offline soon, probably within the next, I think it was within the next 1 or 2 years. And they've recently had some newer projects in Egypt and within Canada that look extremely promising. And now from here, they're really looking at having a new distribution plan, so paying out a higher dividend. They have a target minimum annual distribution of 75% of free cash flow. So that's really, really nice to see. This is the type of company where they're focused on paying a dividend. They're not in it for just having capital appreciation. Obviously, every company wants capital appreciation within their stock, but they're mainly focused on producing cash flow for their investors. This company has a diversified product base. Within Canada, they have natural gas, NGL, and crude. And within Egypt, looks like they are just within the crude. Within 2022, they have a capital plan to advance certain projects and support increased cash flow. And that's what we want. We want increased free cash flow. Free cash flow. They also have other projects that are starting to take over and produce higher revenues and produce more free cash flow as some of their older projects are coming offline. Egypt, they have some contingent resources expected to provide longer term upside. In Canada, it sounds like they have a lot of really positive outlooks in terms of where they can drill. Looks like their current development, they have 19 wells in Egypt, 21 in Canada. What's really cool in Egypt, looks like they have a lot more planned to come online. Here it is. Here's the graphic that I want to show you guys. Get my head out of the way here. They're increasing the wells. They had 7 wells between 2019 to 2021. They're increasing it to 17, as you can see back there. 17 wells in 2022. So over 100% increase in that production. So that's really big news. That's going to be a big pop to their income. Check out their profitability measures. So if we take a peek at their gross profit margin, we're looking at 55% compared to a sector median of 40. Let's drop down to the bottom line, net income margin. They're looking at a 24% net income margin compared to about 7% net income margin. So solid numbers right here, solid performance that the company has. Really something that we like to see. Really something we like to see. Now, if we look at their CapEx, because in this industry they're going to be spending a lot on capital expenditures. Looks like they're doing a good job at investing in their company as well. Now, within the Canadian sector, it looks like they have some really good potential within the next 2 years. Canadian business is capable of generating 45 to 50 million per year in free cash flow, which is huge. So that's about 50 cents per share, and that's just from Canada alone. And I like that. Not that I have anything against the Egyptian market, but if we're to take a peek at the conversion ratio, the Egyptian pound to the Canadian dollar, as you can see, there's been like a drastic drop off, which isn't good. That's not something that you want to see. That means if there's a lot of production in Egypt and they're converting it into the Canadian dollar, that's not solid. Now, obviously, I'm in the U.S. and you can see that's an even bigger drop. So yeah, they'd be falling off a cliff if we're looking at any type of conversion rates here. So the more production that's actually happening within Canada, I would prefer. The more cash flow that we receive from Canada, I think that's a plus. So yeah, I'd prefer more production in Canada, but hey, cash flow is cash flow, right? Moving on to stock number 2, it's VAALCO Energy, ticker EGY. VAALCO Energy is a Texas-based independent energy company principally engaged in the acquisition, development, and production of crude oil. VAALCO's strategy is to increase reserves and production through the development and exploration of international oil and gas. The company's properties are located primarily in West Africa. All right, so VAALCO Energy, I've been watching for a couple months now. Interesting company. Again, smaller cap company. Their market cap's only 420 million. 1 year performance is 176%. Year to date so far, we're looking at close to 100%. Crazy. Man, that's crazy. I really wish I got that before. Stock price is under $7. Earnings per share, we're looking at $2.20. That's solid, super solid. Price to earnings, forward price to earnings multiple, we're looking at 3. Again, really solid. I think most of their peers are going to be somewhere in that 5 range, 6 range. I'm seeing some way higher than that. So solid forward multiple. Dividend rate, they are paying a dividend as well, which is nice to see for such a small cap company. Then, when you see a small cap company paying a dividend, there's some stability there. You know that they're not just, taking all the profits that they have and trying to reinvest it into the company. They've got some sustainability, some level of comfort where they can let go of that free cash flow. Looking at their profitability, we have their gross profit margin of about 58 compared to sector median at 40. And jumping down to the bottom line, their net income margin, 41% compared to just 7 is the sector median, which is awesome. So you can see that they are like very profitable company. And I don't think this is just a shorter term. Let's take a peek at it. Let's see how they've done over 5-year period. So yeah, here you can see in 2020, obviously, every energy company was getting hit hard. And then they really start to recover in 2021, which is when things start to reopen a little bit more. People are driving, going on trips, and now especially even more. So you see that their profitability has been, pretty bumpy, especially in the past couple years. Clearly, but before that, they were doing pretty well. They were up like 14-15%. So good profitability measures overall. What's been very exciting is to see their last quarter's earnings, which was not that long ago, a few weeks ago. They had a beat on their earnings per share of 38 cents. That's a huge beat actually right there for that size company. So that's the big beat right there, and beat what the revenue was expected by almost $9.5 million. So great performance right there. One of their main goals is really to increase their reserves. And as we can see in their most recent report, you can see that they really had a huge increase in terms of their reserves. So that's really positive to see, a 250% increase, 88% increase. So that's good to see. Like if that's their main goal is to increase their reserves and they're actually accomplishing that, that's great to see. They successfully drilled and completed in 2021, early 2022, one of their first wells, their first well drilling campaign, I should say. So they did well with that. They're progressing on one of their other projects, which they have planned for Q3 in 2022. So everything is on budget, on track for that one to open up as well. So that's a plus. And then it looks like they have 2 other offshore blocks as provisionally awarded to them. So some good prospects for this company, at least looking ahead within the next 6 months to 2 years for new projects. And the last thing I'll say about this company is if we jump over to the momentum. Now, I'm usually not a huge momentum player within stocks. I mean, it's something valid that people do, and that's how they trade. I don't know any super successful momentum trader, but Seeking Alpha does track it, so I think it's a good factor at least to explore. And it looks like within their 3-month momentum, they're highly rated, 73%. So I think now with just the prices of oil and energy just fluctuating so much, people are probably being a little bit more cautious than they have been in the past, which is a really smart idea, really good thing to do. So probably slow down a little bit, but they do have really strong momentum within their stock price right now. So just something that I figured I'd share. So that's stock number 2, Valco Energy. Let's jump over to stock number 3, which is SilverBow Resources. SilverBow Resources is a premier oil and gas company that creates value through sustainable, efficient growth in reserves and production, and by contributing to the country's energy security. The company is focused on building premier resource positions and driving returns on capital investment. All right, guys, SilverBow, I mean, they are killing it this year. Over a 1-year period, you just got to check that out. 278%. That's wild. It's wild. Year to date, their performance is still strong, 55%. You're not getting that many places, guys. So again, anybody who's had oil or energy in their portfolio so far this year and last year, you guys are probably doing pretty well. Pretty happy that you do have it. Now, take a peek. Their market cap's a little bit stronger than the other ones. They're at $641 million, and their stock price a little bit higher. They have an earnings per share of 13.27, so strong performance, especially considering the stock price, and forward multiple under 3. Let's review their profitability right off the bat. So they've got an A+ rating. Their gross profit margin is at 89% compared to sector median at 40. So just knocking it out of the park. They're crushing it right now. Their net income margin looking at 21% versus under 7. So again, this company is just crushing it in terms of their profitability, and that's something that you really want to look for. Especially right now, the markets are too volatile. There's too much fluctuations here. People are going to be navigating towards these companies that are profitable, companies that are consistent, companies that are making money. These other companies, a lot of tech or growth companies right now, they aren't making that much money, and their multiples are just out of whack. And people are leaving them. They're getting worried that the company's not going to stay in business, so they're heading to some other place that does make money. Well, guess what? This company's crushing it. Looking at their CapEx, they're also doing a great job reinvesting into their company. Checking out their earnings, they did miss their earnings just by a little bit, but also I'm not even worried about it. Normally, I would be, very concerned, but they've been reinvesting into the company quite a bit, as you can see by the last screen. But here it goes over their history of their earnings, and you can see that they have a really strong record at beating or exceeding their earnings estimate. So I'm not worried. Yeah, you get a couple quarters here and there. It happens with every company. Nobody's perfect, seems like, except for Google, always knocking it out of the park. But this company is doing solid in terms of their earnings. Let's jump to their corporate presentation. They just recently had one earlier this month. I believe they had 2 acquisitions within this past year. So that increased their free cash flow from 53 million up to 84 million. So huge. I mean, that's $5 per share. That's fantastic. They have a lot of liquidity, so their balance sheet's looking very strong. Not something that you need to worry about them going out of business, at least not overnight. Now, if we take a look at their production and efficiency, looks like they had a 41% increase year over year. Yeah, here we go. That's a big statement right here, guys. So they generated Return on common equity, 23%, and free cash flow of $84 million in 2021. So really solid performance here. This company isn't as much focused on producing dividends or anything like that. They actually don't pay a dividend. This company is really focused on reinvesting and acquiring other assets. So they're really focused on growing right now, not focused on paying out a dividend. So a different concept from the last company where they were paying a dividend and really trying to just build their asset base and then create more free cash flow. This company's not. They're looking for growth. They're looking to acquire. So completely different concept. And it seems like it's doing pretty well for them. Clearly, it's doing pretty well if they have 278% return in the last year. So they're doing well. They're doing something right. So now their key objectives for 2022 is really they want to scale. They want to scale up. Who would have thought, right? Who would have thought? Double-digit production is really, that's impressive. High return on their inventory through leasing and acquisitions. And then obviously they want to optimize their capital and delever. So they want to pay down some debt too. And again, the last thing I just want to show you guys is their momentum grade through Seeking Alpha. Looks like the last 3-month price performance has really been strong. So it's having an uptick within the last 3 months, which is a good thing. It's another good sign. Over a year, A+ rating, and you can see that it did slow down within a 6-month period, but again, looks like it's ticking back up. So doing really well, especially compared to sector medians. So yeah, just wanted to bring that up. Again, momentum isn't one of my top things that I look at, but it is one area that at least good to fill yourselves in a little bit. So that's what I got for the top 3 energy stocks as of right now. Again, I've done another video on other 3 energy stocks, which are just really crushing it. They're knocking it out of the park. They are still, I believe they're still going to be doing well, especially, Obsidian Energy Group is doing fantastic. Grand Tierra Energy, another one that's doing really well. And I believe it was Petrobras or Petrobras. I'm not sure how you pronounce it, but another really strong company. Those 3 doing really well. If you want to see the video, just click the link wherever it pops up. But this one here, these are 3 smaller cap energy stocks that I think are just primed to be doing well for the next, I think the next year. They're all repositioning themselves, especially with crude being so, the prices of crude being so high right now. It's really helping them out to pay off a lot of debt, acquire new assets, move into other parts of the market, and really produce drill more wells. And again, just be aware that they're smaller cap companies. There's going to be a lot more volatility within them, and they're within the energy sector. Anything within the oil, gas, energy industry, it's going to be volatile. It can move very, very quickly. A lot of political tensions and risks around there as well. So just be aware of that. If you have any questions, if you should be investing in any of these stocks within your own portfolio, feel free, click the link in the description down below. We can set up a one-on-one consultation, do a review, and see if this does make sense for you and your portfolio, or if there's some other options instead. There could be other things. So that's all I got for today, guys. Don't forget to subscribe to the channel, hit the like button. Really appreciate that. And I'll catch you guys next week. Take care.